G'day everyone, welcome to this weekly video update. And the week that we've just had is a really defining moment in financial history, and it's going to have an enormous impact on all of us in the future. I think people will look back in decades to come and really see this as one of a handful of absolutely defining moments. So let's get on and have a look at what the decision the Fed made and what the implications of that are, because this has now created a situation which I believe is even better than what I anticipated it would likely be. So to start with, the market was universally expecting there to be some sort of small tapering by the Fed of their bond buying program. Even symbolic, if they could just reduce from the $85 billion a month, maybe down to 75 or even 70, then that was already priced into the market, and that was what everyone was expecting. In recent months, I've actually expressed my doubt that the Fed would be able to do that. I wasn't trying to predict anything. I was just really looking at the reality of the fact that interest rates were moving up and that would make it difficult for the Fed. And in the end, that's effectively what happened. But their decision is more about what they're likely to do in the future. I think that's really the more relevant way to look at it. We saw some very sharp moves in the market on Wednesday. The market went up massively, created a new high, and then it came back down again on Friday. Those sort of short-term market fluctuations are not the point, so I'd really encourage you not to focus on those. It's the implications of the bigger picture and what that means for the opportunities and also the dangers for us as well in the future. So the Fed must avoid several things. Now, interest rates had started moving up merely in expectation of the bond buying program. The 10-year yields had moved up from 2% to nearly 3%, and the 30-year yields had moved up from 3% to nearly 4%. They're massive moves. So that was merely an expectation. Now, the Fed must contain rates. They can't allow interest rates to get away from them for a couple of reasons. One, the impact on the housing market, and secondly, the ability of the US government to pay its debt. If interest rates were to go up further, then that makes it incredibly difficult for the US government to deal with those interest rates, and you just get caught in a spiral where you've got to print more money, which causes higher rates, which means more money, and ultimately you end up in a Zimbabwe kind of situation with inflation just going absolutely bananas. The second thing is that unemployment remains unacceptable according to the Fed's own yardstick. So there's not a lot that they're going to change while unemployment remains where it is. And the other part of the unemployment is that the figures are artificially low because there's a few 100,000 people that have just basically given up looking for work altogether. And the third thing is that there are budget cuts already in place by law that are fighting against what the Fed's trying to do. The Fed's trying to stimulate the economy, and the budget cuts are working in the opposite direction. So the Fed must avoid those things, and tapering their bond buying program was going to be contrary to that. Now, the choices that the Fed has, I believe now that tapering is a no-go pretty much ever. Now, when I say ever, I'm talking about the time frame until there is some kind of crisis of confidence that causes the whole financial system to fall apart, as I believe ultimately that it will. Just won't be for a little while yet. And so I believe between now and that point in time that the tapering of their bond buying program is just not going to happen. And in fact, because the things that they've done in the last 4 years have failed to work, they've failed to achieve the outcome that they wanted, then I believe we're actually going to see expansion of stimulus in 2014, not a reduction. So I think that's a very, very real possibility. Now, the implications of all that, it's putting upward pressure on the US dollar, putting downward pressure on the US dollar, I should say, and that's happened already. The Aussie dollar has already jumped a few cents. I believe we'll see the Aussie dollar head back towards parity, and it will also put upward pressure on commodity prices, including gold and oil, and therefore that'll be inflationary, particularly the upward pressure on energy prices. So for me, this is the stock opportunity of a lifetime. It's even better than I imagined that it would be, because it was pretty much everyone's expectation the Fed would start tapering a little bit. So a terrific opportunity in front of us. Now, looking at the week that's just gone, the S&P index ended up gaining 22 points. We saw a huge breakout on Wednesday and then a retest back to the breakout zone. So technically that's all in order at this stage. For me, the medium to longer term, the market is heading higher as long as interest rates are contained. Now, if interest rates start to move up again because of a lack of confidence in what the American government and Fed are doing, and the hurdles that I would point to would be 10-year bond rates above 3% and 30-year bond rates above 4%. Then as long as interest rates are contained, then stock prices, I believe, are heading higher in the medium to longer term. In the short term, I don't know, I don't care, it doesn't really matter. We're trading really on a 1 month to 6 month kind of time horizon. So we've now got a following breeze. It makes it easier to trade with confidence, but you still need to be disciplined. I think we'll see plenty of volatility. Now, I don't believe we're ever going to see circumstances this good again in our lifetime. And the reason I say that is not to be sensational about it, but just to look at a common sense set of facts and self-interest. Interest rates are at record lows. That's good for company profits. There's no question about that, and that's been happening. But it's also going to force people who, since 2008, don't want to be in the stock market. So I'm talking, retirees and other people that are nervous about the volatility in financial markets and have effectively been out of the market since 2008. It's going to force those people back into to the market again, because they're just not getting an adequate return on their money with interest rates so low. And as I said at the start, if you look at things through the prism of self-interest of all the people involved, the government, the Fed, retirees, investors in general, then you're going to be pretty close to the mark in terms of how things work out. The second reason is that that credit is still very easy to get, and it's basically assured for the foreseeable future. The Fed has said we're not going to taper yet. We're going to keep stimulating the economy to the tune of $85 billion a month. The third reason is that the Fed is determined and they've got the firepower to pull this off. And the fourth reason is that there's not that many people that are actually bullish at the moment. People aren't talking about the stock market as a main topic of conversation. And stock market tops occur when most people are invested fully. That's what creates a top, the fact that there's no new money to come into the market. You don't get tops in the market when there's a lot of people that are still yet to come into the market and everything is forcing them to do that. There's never ever been a market top when interest rates are low, when credit is easy to get, and when people aren't universally bullish. People are still worried about lots of things in the Middle East and Europe and all sorts of things. So to me, there's just no way that we can have a top at the moment. The conditions just are not in place for that to happen. So the message that I want to put across is that the time to do something, if you're ever going to do it, is now. But there's also an imperative to do it now, because I believe what's coming is not going to be particularly pleasant, and it's going to get much, much harder to make money once we get through this next period, which could be anywhere from the next 1 to 3 years. I think will be particularly good, could even run a little bit longer. Now, the reason that I think there'll be that sort of window of opportunity is because it takes a while for the factors that I had on the previous slide, which is low interest rates, the fact that people aren't universally bullish. It takes time for those things to change. They don't change overnight. So I think we're going to be in that situation, and with the Fed driving everything the way they are for absolutely at least a year, and more likely 2 to 3 years. So that's the window of opportunity when some very substantial profits can be made. After that, I think it'll get very, very nasty, and so you want to take the opportunity to make as much money as you can while that opportunity presents itself. So let's just have a quick look at the S&P 500. So you can see we had pullback in June, we had another one in August, and now that we've gone up and formed a new high, that happened on Wednesday. We had a pause on Thursday, and then it pulled back to that breakout zone on Friday. You can see that the RSI was quite overbought, so at this stage this looks purely technical for me. It might pull back further in the short term, but medium to longer term I believe the markets are heading higher. Now the ASX 200 gained 57 points on the week. It's risen beyond the double top that we looked at last week. There was some very unusual price and volume movements late Friday in the last 20 minutes or so. So it'll be interesting to see what happens on Monday with those particular stocks, given the lead we had from America, which was obviously quite negative. I won't even bother looking at the chart for the ASX 200 index. I just don't think it tells us anything for the sort of stocks that we're trading. Now looking at gold, the fundamental drivers for gold just got stronger. The price of gold had sold off because people thought that the Fed would be starting to wind back stimulus, and that wouldn't be a good thing for gold. So they just got stronger, and I think it's quite clear now, if you go through that logical sequence of thought that I went through before, that the Fed either clearly won't stop printing or can't stop printing. And if you take the second one, which is they can't stop printing, then it does concern a little bit about what they aren't telling us. You know, are circumstances worse than what is kind of universally acknowledged? We'll find out about that in time, but it really shouldn't stop you being in the market. In fact, it's actually a main reason that you should be pursuing the market as hard as you can, to make as much money as you can during one of the best periods that you're probably ever going to see. Technically, for gold, to prove that it's back into an uptrend, it needs to close above 1435. For the first time in over a year, I'm finding the price action quite confusing and unpredictable, difficult to read. So I'm not going to try and predict what's going to happen or try and assess what's going to happen in the short term. We need to close above 1435, and I think we can expect some short-term consolidation until that happens. So let's have a look at the price of gold and silver. So gold has been progressively moving higher. You can see we've got higher highs and higher lows. We had a very big move on Wednesday. The price of gold jumped by about $60, paused on Thursday, and then fell by about $35, $40 on Friday. So moving pretty much in the same way that stocks did as well. I find that whole pattern very confusing, so I'm not even going to try. This is silver. Also went up heavily on Wednesday, but fell back most of those gains on Friday. So we'll just have to see how that unfolds. But my view is that all the drivers are in place to continue to force precious metals prices higher over time. So overall, gold finished flat on the week. Copper rose again, so quite positive, up to $3.28, and oil slipped back to 105 with things in the Middle East easing off just a little bit. There's the price for the spot copper chart. So it's just remained in this big broad sideways range that is pretty profitable for most of the good copper producers. So from a strategy point of view, it's hard to see the typical September, October low that we get that generally follows some sort of sharp correction. It's pretty hard to see that happening now. We're this deep into September. So it's quite possible now, with all of the things that I've explained over the last 10 or 12 minutes, that we are going to see a lower price than what we saw in August. So I still believe this is one of the best buying periods of the decade. There's absolutely no reason for anyone who's interested in the stock market not to be pursuing this. It's never going to get any better than this, and in future years it's going to get a whole lot harder. So an opportunity to make hay while the sun shines, that's for sure. All sectors are offering opportunities. Requires a very disciplined approach and a very well thought out approach to what you're doing. It's not going to be a situation of a tide rising all boats, just buy any stock and you're going to make money. There's definitely a way to do this, and there are opportunities range trading or in fact in new bull markets that are emerging where there's going to be some spectacular gains, and we're already seeing the early stages of that happen so far. Now, last week I mentioned that, or I invited both members and non-members to the Share Wealth Club, the monthly training session we have here in Perth. It was really well received. What I did was I did a review of the three-step selection process that I use. Been through this before, but it's vital when you've had a good period, and we've had a particularly good run this year. It's easy to get carried away, to get greedy, to get too bullish, to start to move away from the processes that have worked so well. So I went through that again just to make sure that members were continually refocused on staying with the processes that have worked so well this year. Went on to some other psychology, part of another step in the psychology development chapter as well. So it was a session that was really well received. And for members who are out of Perth, of course, the session's recorded, so you've got the opportunity to benefit from that as well. So for anyone that who's a non-member who's interested in finding out more about what we do to see whether it's suitable for you, then please get in touch with me. There's my email address. But look, if you're going to do it, do it now. There's just absolutely no point in waiting any longer to see how things pan out. It just doesn't get much better than it's going to be in the immediate future. So that's it for this week. Cheers.